Good morning, everybody. Welcome to the Flow Show. Nice to wake up this morning and find that the world hasn't ended and that market's a little bit calmer today as we come into trading. Morning, Kay. Sleep well?
Hi, morning, Ryan. Yeah, really slept well, thank you. Yep. Indeed, calming down a little bit. Some things making a bit of a comeback as well, but we're not out of the woods yet by any means, right?
Yeah, still plenty of volatility in certain assets, namely dollar yen is the one that's moving around at the moment, more so than some of the others, but we are seeing a little bit of a dollar bid coming in, but we'll go over that in a little bit. We'll get over some of the headlines first. Yesterday, there were some reports that China state banks had sold government bonds in large sizes. Now, this was part of the plan that China was going to put in. Whether they pushed that forward a little bit, got the banks in just to steady markets amid the turmoil yesterday, I don't know. That remains to be seen. There are reasons for that, but that was the rumoured story yesterday. Over in Japan, we've had new man Mimura, who the guy replacing Kanda, had a meeting. The government, the F.A.C.E, the regulatory board, and the BOJ discussing moves in financial markets and the stock market and whatnot. No real comments from him. He's well versed in the script, monitoring markets with a sense of urgency. Moves need to reflect fundamentals, the usual waffle. There, nothing new from him. Suzuki was out though, also speaking amid this meeting, saying we'll continue to monitor and analyse financial market moves and work closely with relevant authorities. We'll do the utmost to manage the economy and finance while cooperating with the BOJ and make judgment on the current situation calmly. Also seeing bright aspects in Japan's economy on wages and the investment front. Now, things were much calmer in Japan, the Nikkei actually rising quite a bit. They were eased off into the close, but potentially we might be over the worst of those moves, but we'll wait and see. Those bright aspects that Suzuki was talking about showed up in some of the numbers overnight. We got overall wage income up 4.5%, a decent jump there. Versus 2.3% expected and 2% prior. Overtime paid picking up there too. However, the big number out of that lot was real cash earnings went positive. I believe it's the first time in over 2 years. It went to plus 1.1%. Was expected to come in still negative at minus 0.9% from a prior minus 1.3%. So positive real earnings or cash earnings in Japan year on year. That's a good sign for Japan. Let's see if it's maintained. Other numbers not looking as good though was household spending. That was down 1.4%. So doesn't look like those higher wages are translating into higher spending just yet, but it still may be early doors as those wage increases filter through. Overall, Kay, if you just take that aside from volatility in Japan, fundamentally, it's still good news for the BOJ, maybe to keep on their tightening path.
There's a couple of things to consider here. I think the problem with the households in Japan that we know it's been an ongoing story for the past 2 or 3 decades now. It's like they're savers, right? Part of it is I hope that they didn't put everything in the Nikkei, but yeah, that's always going to be a bit problematic because and also with the yields higher and the Bank of Japan having raised the interest rates, a fair bit will still go into savings and less into spending. Japan is per se not a big already per definition, already not a big spenders community, but also we have seen over the last years that more and more people are Yeah, even screwing back prices being that high, they don't have that much to spend. So that's a bit of an issue. The wages going up, that's good news for the Bank of Japan. Um, but then we need to look at what happened over the past week or so. Whether the Bank of Japan has missed its window or jumped out of the window while it was closing behind its back. I mean, that's going to be the question going forward. There's they probably, and thanks also to the rest of the world cooling down, probably saved the JGB market, probably saved the Japanese yen, but now are they going to sacrifice the Nikkei and topics? That is going to be a big question to me. And that meeting that the MOF, F.A.C.E, Bank of Japan had overnight, I think it's a bit of a first warning sign that they may not be willing to sacrifice all of it. And if you look at how they want to keep their economy going, I think they may want to consider how they are going to save stuff like the Nikkei. And then I'm thinking about Buffett and all his suite of followers. If you want investors to give them a global name, if you want investors to come into your market, you need a stable asset market, and the equity market is part of it. So I think they are in front of a little bit of a choice to make there in Japan.
Yeah, very much so. And we know it's another slow-moving oil tanker getting consumers over there spending more. But that's the hope from Kishida and his virtuous economic cycle that he's hoping to strike up. That people earn more wages, they see they're getting more money, and then just change the mindset and get a bit more of that going into the shops and other things. But as we know, it's a long old process over in Japan. But if these numbers keep going the right way, then that process should touch wood unfold over time. Right, over to the RBA. They left the rate unchanged as expected. I was certainly looking for any signs that they might have turned a bit more dovish. That wasn't the case. They kept their lines in the statement that they won't rule in or out anything in terms of policy. Inflation still being a bit of a stumbling block and remaining sticky over there. So there was some subtle language changes, but nothing really noteworthy. It's steady as she goes from the RBA. Anything you picked out from that one, Kay?
No, just as you said. But we know that she's a bit of a hawk, right? So she wants to keep all possibilities open. I still think though that in especially also in the global context of things, I can't I can't see them hike, to be honest. Whenever that may be, especially not if the economy is slowing down. She's still hiding behind all inflation metrics, but I think the market is right to price in some form of cuts to come. But yeah, I mean, in the meantime, they just keep the course. They can, because they are about 1% below the Fed if they're already looking at the US. So they still can keep it on hold for now, and then we'll see what the next set of data is going to bring.
Yeah, exactly. So steady as she goes from Australia. Over in Germany, bit of good news. Factory orders showing a decent jump, 3.9%. These numbers have been a bit wild of late, but as you can see, they're smashing expectations. And last month, the workday adjusted year-on-year number coming in a less crappy 11.8% was expected to come in minus 14.2. It came in minus 11.8. Those still worse than last month's minus 8.6. So not out the woods yet, but still a decent bounce on the month there. As Kay likes to recall, the Rhine levels must have been high. They must have had some rain over the course of that period to get things moving. Eurozone retail sales came in at 0.3%. Minus 0.3%. there on the month was expected to come in flat, so a little bit worse year on year, a little bit worse as well. So again, Eurozone, pan-Eurozone numbers not showing any boom type numbers from there. Right, coming over to the US, and things happening yesterday. So going into all the US data, the S&P Global PMI and the ISM, SOFR and Fed Fund futures still pricing in an inter-meeting cut. The final S&P Global number in the US, where is it there? Dipping back from the flash number 56 to 55 and going lower than last month, 55.3, still in positive territory though. And then hilariously, all eyes were on the ISM and particularly the employment number, and we came in at a positive, so moved into expansion. This broke a 5-month streak of negative or contracting jobs numbers. You can probably call it 6. So there was a little bit of a blip in the January number, but once again, just when you think the shit is hitting the fan, you get a number that turns things right around. So that gave the market a little bit of a knock. I was just sitting there laughing myself when I saw that number. All the rest quite positive as well. The PMI itself moving into expansion. Prices paid moving up a touch as well. New orders going into expansion. So this services sector looking fairly more positive, more so positive than the manufacturing number anyway. Okay. Typical, isn't it? Everyone's looking for a stinky one after the NFP. We're pricing 50 basis point cuts, 130 pips of cuts by year end.
Yeah.
And then you get numbers like that.
Absolutely. We were saying, like, what if this comes out positive? And it actually, and it did. Yeah, what to say? It's people were, we were saying straight away, people were a bit going crazy on wondering if the Fed could start to cut panic cut this week. I mean, this number clearly put that one in the bin. Yeah, it is positive. Services are also a bit more important than the manufacturing, so we need to keep it into account. I think some currencies, barring stuff like yen, Swiss, or something which is on their own planet. The rest actually had to respond a bit favorably towards the dollar. Take the main ones: the euro, the cable. Coming down a bit, and the dollar picking up steam. And actually, we've seen a pretty good rally in the dollar yen as well, right after the fixing. Yeah. So yeah, we have to keep our both feet on the ground in regards to Fed expectations and what they actually may do. As I've been saying so many times, the pendulum swings. The market has to do stuff. And also, when we see all those bond moves and the Fed Fund futures move and things, it's also a factor of the market needing to do stuff and needing to rebalance the books and things. We always need to take those when people say like, oh, we are pricing in as much. We always need to take it with a pinch of salt. And yesterday we needed to take it with a huge bag of salt.
Yeah. Because it needs to be said, particularly when we get these volatile signs, there's lots of different metrics for measuring, Fed expectations. You hear it, money markets are pricing this, traders pricing that, futures are pricing this, overnight rates are pricing that. When things are volatile, the numbers that then get extrapolated from that by the models aren't really reflective of the underlying real market in terms of what expectations are. We heard crazies and extremists coming out saying the Fed needs to cut 75 basis points now, and you get the banks jumping up and down on it. But you have to then wait for the cold light of day, and things will just calm down a bit and see where things are standing to get a better feel for those rate expectations, but I'll touch on that in a moment. We'll go over a couple of the Fed heads that were out. Goolsby's been grabbing every microphone he can at the moment. He was out speaking to CNBC yesterday, and he actually got the market going a bit the same way again. He started off by saying the jobs number was weaker than expected, but not yet looking like a recession. But on the other side, the GDP number was stronger than expected. We should respond to conditions on the broad through line. Inflation is way down and employment is at relatively decent spot. The Fed can wait for more data before the September meeting. The Fed's job is not to react to 1 month's numbers on jobs. If jobs data is a longer term sign, we should then respond to what those forces are. If stock market moves gives the Fed indications over a longer arc that we are looking at deceleration in growth, we should react to that. And then this comment came out. He was asked about an emergency Fed cut, and he decided to use the line that everything is always on the table, including raises and cuts. Now the market took that as a bit of it drew a bit of conclusion amid all these headlines that we were pricing a 60% chance of an intermeeting cut within a week, effectively, as that pricing suggested. So the market took that comment as suggesting that maybe there's some truth to that rumour. However, he then spoke to another reporter later on, one or other Jenna Leaks, as we like to call her, the New York Times, I think she's at. And she questioned him on what he actually meant by that comment to CNBC on the emergency cut. And he said that he was talking about the Fed's dual mandate goals of employment and inflation and not about the stock market. So a bit of clarity there. But the way he's been saying things at the moment, he's a bit of a loose cannon as far as some of his comments go, and maybe needs to just tone it down a bit. Anyway, Fed's daily was out as well, saying more confident inflation is on a path to 2%. She advised against overreaction to individual data points and encourages an analysis of the overall data underneath the jobs report. Says there is some reason for confidence. We are slowing but not falling off a cliff. On policy, she says a steady in the boat approach works well. And on jobs, she said she called some of her CEOs in a San Francisco district and says that firms are not laying workers off, just slowing hiring, which is a fair point because we saw that NFP, it wasn't a negative number, it was just a softer number. So there were still job gains. If we start seeing negative NFPs, and that's a whole different thing, even with unemployment potentially rising. Yeah, Gavin, let's see, you'll screen about 275 basis point cuts. I don't know where they get it from. It's clickbait. It must be clickbait. Anyway, back to pricing. Now, here's something, if you don't have this in your bookmarks, it's something to have a look at. It's called the CME Fed Watch, which gives you a good broad overview of rate expectations, if you like, although there are differences between metrics, as James and K-Man pulled up in our room earlier. So for the 18th September meeting, this is the probability of a cut. As you can see here, this is a 76.5%, it's gone up a bit, of rates being in the 475 to 5% mark, which is 50 basis points below where we're currently at. The balance is for a lesser cut of 25 pips. Now, if you go to the December contract, and this is where we're getting some heavy pricing for 100 basis points of cuts, this has come down. We were pricing this much higher yesterday. We were pricing a 50 basis point September cut at near 90% yesterday. So these numbers have come down a bit. So basically, Fed funds futures here and the model they use to extrapolate these probabilities showing a 45% chance now of 100 basis points of cuts into the December meeting, or by year end, let's call it. So I think this September one, gone up to 80% now. So as you can see, it changes pretty quickly. It's not 100% reflective, as I say. There's different models show different things. You can look directly at the futures price itself and extrapolate that number. But even if we just take that at face value, I think this is still a little bit rich. It's still very high. Pricing in 50 basis point cuts, given what the data we've seen so far, and we will get more data before the Fed, obviously, so inflation numbers, PCE and the like. I don't think, personally, still a 50 BP cut is valid, though I remain to see the rest of the data. So based on just looking at these futures and the way they are, we're seeing a bit of a bid in the dollar. I think this might have a bit of unwind still to come, and that should mean that the dollar is remains a little bit bid, maybe turns a bit higher as well. Certainly, if we look purely on a yield basis, yields are recovering across the board, particularly in the US. We're seeing an up move in yield, so they're showing a little bit more calmness after these moves yesterday, but where they go to now is anyone's guess. Kay, do you think we're still in a little bit of needing to wash some of these moves out, these extreme moves out?
I would assume so. Yeah, I think it's comparing to the data. Yeah, we know the data are turning down, and the Fed also knows that. Powell spoke about it. But will they go for a 50 BP cut? You know what? I mean, if stock markets wouldn't have dumped as much, I would say this is clearly too much. Now there is a bit of equity market watch to be done, in my opinion, because if they go lower, Fed Powell did say something about supporting markets. I would say that if those equity markets continue to trade lower into September, then those probability will probably be even higher, and they may do 50. Where we stand right here and now, I am going to say that 50 is a bit overdone, and I would rather go with the 25 still.
Yeah, no, I can get with that. The thing is, if we do see a bit of a pullback in these numbers, yes, we're going to see the dollar gaining a bit, but where that goes is going to be the question. The market is now, it knows it's getting a cut. It's been waiting for a cut for forever, for probably the last year or so. It's been waiting for a cut. So we know a cut is coming. So, you know, how much we can bounce back in the dollar before we then need to know how many more cuts are coming and how quickly they're coming. The market is still, again, probably overpricing the amount of cuts through to the end of the year. So there is a little bit of adjustment to be made to that, but it doesn't mean the dollar's going to rocket higher. So it's the old dropping a pebble in the water. We've had the big wave yesterday, now we're going to get smaller waves for the next few sessions or days, if nothing else happens in markets, of course. Right, just looking at the last bits and pieces. What else have we got? Yeah, so Goldman's was out with a bit of colour on what went on in Japan, and they said that Japanese focused hedge funds saw losses of 3.7%. It's the largest single daily performance decline on Goldie's records. They said over the last 3 trading sessions, those Japanese focused hedge funds were down 7.6%. And as of Friday, they sold Japanese related assets at the highest pace since the COVID saga. So that's Goldies with their metrics of that. Do you think that sounds about right, Kay? A little bit of panic move seen there. Obviously, now we've seen a bit of a bounce. It looks like we're over the worst.
In what, sorry, Brian?
In Japan, mate.
Yeah, I think so. As I said before, the fact that they had this meeting, the rout may not be over, but I think if we see another move lower, they should step in. And actually, they may not show it in the numbers, but I think there has been it's possible that they did some price keeping of operations overnight. But we may only see it in a couple of days or so in the numbers, or even end of month. I don't know. Yeah, and as I said, there's going to be a choice to make. And if you look at it from an investor point of view, are they really willing to give up Nikkei? And because that's a very big barometer for investment. When people want to invest in a country, you need a stable equity market, and you need a stable asset market. And so yen side, okay. JGB looks to be okay now as well, because we are well below 1% on the 10-year. So that market has, at least for now, completely calmed down. But I'm really wondering what they are going to do about the Nikkei, really. And I wouldn't be surprised if they step in buying ETFs and stuff to try to hold it up. On the other hand, is the worst over? There's all those articles going around in the market where one of the biggest banks is saying that the carry trades are only being have only been unwound by half or so, which would mean that there may still be some stuff to come or to be done if they already want to step out of everything. I thought we would be much further down that road now, because it's been going on for 2 weeks. But they kind of saying that the speed of things was such that perhaps not everybody could get out of their stuff at reasonable rates, so that there may be more to be done. So it's a bit of a tough call to know whether it's all the worst is over or not. Put a gun to my head, I would say for this round, the worst is over. And then now we will see what really the Japanese officials want to do with it, because Kishida wants to create this virtual circle, but you can't do it without your equity market holding up, right? So
Yeah.
I suspect that they are now putting their heads together and see what they can do about it.
Yeah, but to be fair, all equity markets in the same boat at the moment, so it's not purely a Japanese thing. Although, the size of the moves there are absolutely monstrous compared to others. Pretty much wiping out all the 2024 gains at one point. But if you want to look at it from a purely trading perspective, we've bounced. We had an old resistance area there. We're back above there. It was all noisy in here. So we've got a marker. We've got a marker on the downside. So if we do see downside moves in the Nikkei, you need to see where the levels are going to show up. If we start bouncing off of here, then that's going to give it another base to at least take some of these losses back. You need to be looking at this low here. We had that low, a subsequent low there around the 32s. So, you can probably take it as just playing the big figures. So if we do get another move south, if it holds above these lows, then we maybe start to see a bottoming pattern coming in, which again might give it a springboard to move back higher. But again, we've run into resistance. We did close a bit lower off the highs. So this area here, 35s, 34.5-ish, 8s, whatever. That's your sort of area to watch now. You need to break and close these gaps, break these highs, and then the more that does, the more that will encourage people in. There's probably a lot of people now just sitting on the sidelines. They got a bit of a kick in yesterday, and now they're going to be a bit reluctant to step in too fast. That's how markets work. So once things steady down, that's when the money starts coming back in, when things are a bit calmer. That might take it higher. So we're not out the woods, as Kay says, but we've got some points to measure where the woods are and whether we stay in them or out of them for now. And that's all you need to know trading wise. So having a little look around at some of the others, I had a little dibble or a little dabble in S&P yesterday. I bought it just before bed because I thought if the Nikkei bounces, if it does show a strong bounce, and obviously we're going to see other stock markets following suit coming in to today. I didn't want to get directly into the Nikkei in case it crept out again with all that volatility. And I thought if the Nikkei did crap out again, then other markets may become a little bit more detached, making it a Japan only thing. Anyway, I got in I ended up doing a little bit of a chase. I got in at 52.40 not long after futures opened. Managed to get 20 pips away overnight, and then got stopped on mid balance on the other half at -15. So I managed to take 5 pips out of it for not great, but I made money, and that's the main thing. But we're in a little bit of balance now. Again, similar pattern. We've bounced. We're hitting our head close to some old levels, 52.80s. You know, now it's just a bit what happens next. We've got some old levels down here that got carved through on the way down. Will they show up again now things are a bit calmer? So if you're trading stocks, again, we're not out of the woods on this, but let's see what the US wants to do when it comes in later on. Does it want to follow the bounce in the Nikkei? Is the drama over? Are buyers more eager to come stepping back in? So it's going to be another important session for stocks. Going to have a quick look at dollar MEX just to look at what Kay was talking about. This looks like a big old. If carry traders are getting knocked out, they're getting knocked out on the break of the 20 level. So you know that's probably half of that's probably a stop run. More people who were short, you know, psychology, big figure, 20 level. That's going to knock a few people out. It's dipped back to the old level, 1920s. That fib that we held just before the break, we're sort of holding it again. So that's given us a little bit of a support marker there. We were talking about this in the room, Kay, just to go back on it. You know, it's a tale of different times, isn't it? You've got all one thing you need to learn, people, is that all the smart money, all the big money gets in early in these trades. So they're all in above 20. What happens here is all the smaller money, even the retail crowd, getting in. And so they're in at worse levels, and they're going to be the first to fold. If you're still up here, you're getting a bit worried, but you've got your protection. You know, you can still have a stops above 21s if you're that way inclined. But this is still looking like it's catching out the short-termers, Kay, because the way it's dropping back after.
Yeah, and I think, Brian, looking at the timing that it happened, feels very much yesterday early morning in Asia that Mrs. Watanabe, sons and cousins have been knocked out there, yeah, nephews, and perhaps some of the other Asian traders as well, because I mean, carry trades are not solely done by real money or big money, as you say. I mean, there's a lot of retailers, and the Japanese retailers, among others, are extremely invested in those because they have been starved of yield at home, so they are looking abroad. And let's also not forget, if you have been, and I invite people, and it's a free page, to just look at that investing.com page, and you look at the not even trying to get to all of those crosses, but go on the forwards rates page and then click on dollar mix. So markets drop down, Forex forward rates, Forex forward rates, Forex. Yeah, forward rates.
There we go.
Go on to the dollar mix. If you're being short, and I'm just taking the dollar mix, if you're being short in the carry trade since when it really started off, right, 2021 into 2022, but only 1 year. If you are 1 year short dollar mix, and you sold it at 22, you're now short above 23, and that is the real carry traders are looking at that before they even consider about really what is it going to do on the FX market. They first look at that. So what am I going to get? And assuming that they've been short for at least a year, why not even 2? Because then they're even two real big figures higher short. They look at this before considering even the FX rate. And what happened over the past 2-3 years, barring the last, we had this little. We had a bit of a scare in September last year. We had a scare in February this year. Then another one in May. Then the big one, of course, the last couple of weeks. But if you look at those real carry traders, some of them will still be in it because they just got that much carry over the past 2-3 years. And actually, FX during those 2-3 years has been moving in their favor. So now we are just getting back to levels where we were perhaps 1 or 2 years ago, and they will still make a lot of money. So I as Ryan also said, I think for the real longer termers, there may still be partially at least, because they also look at fundamentals, they look at politics, they look at risk, other than just prices and effects. So I guess that they are out for a part and took actually profits. But yeah, I think some are still in it because they just made so much money over the past number of years, and a lot of carry traders assume actually the real money out of experience when I was in banks, they assume that FX is not going to move too much because they know that a carry trade is usually in a currency that is not as strong as the majors may be. And here they got the double tailwind of a currency that actually was very high in interest rates and also strengthened over the course of the past 2 years. So I think a good few of them will still be in it, but the shorter term they have been rinsed out. That is for clear. That is clear that there will be short to medium term positions have been, and I would argue I would disagree with JP Morgan saying that half of the carry trades are still in it. I think more have been washed out than that. But the real long termers, they will probably still be at least partially in it,
Yeah, yeah, and of course, like you said, it's not as if they haven't made any profits selling up here and buying it back down here, just on the FX side, let alone the carry.
Yeah.
So there's that side to it at all. But yeah, I find it very difficult to see a situation where we get back down here again. So one would have to say, yeah, we may get some pullbacks, but it looks like we could be heading much higher on this one as things unfold.
Yeah,
Yeah,
and also we cannot forget that in Mexico itself, Scheinbau and AMLO are still thinking about what they are going to do, and that's also one of the reasons why I think a lot more carry trades have been unwound than what some people may think, is that the political situation in Mexico has probably raised a good few antennas, and those people have been probably buying a fair bit. Not all of it, but a fair bit of their carry trades. They probably have been buying it back on actually Scheinbaum's election to start with.
Yeah, very much so. Paul's asking, will the M pairs continue to move lower or more consolidation? Depends on your metric. Are you talking about an hour, over the next hour, over the longer course? Let's take it in two context. Let's take the short term first. Okay, yes, we could bounce a bit more than we have done already once this washes out. This one, again, it's obviously following what's going on in Japan a lot. So probably for the next few sessions, we're probably going to judge this, at least in the early part of the day, what happens in the Nikkei and stocks and whatever else over in Japan. So that should be your weather vane, shall we say. Now, can we go higher? Yes, but again, the reason I would think it goes higher is if we see US yields or yields in general going higher as well, because that will show, again, a bit of an unwind of this Fed elastic band stretch for the expectations. So can we bounce higher? Yeah. Where we go, no idea. I think we're going to have a little test, or it will be a test, this 147 area. We're already finding resistance into an old level, 146.5. We've got a bit of support coming in, 144s, mid 144s, shall we say. So there, for me, is your battleground. If we get above 147, then we're probably going to push on a bit higher. If we're back below 145s, 144.5, then maybe we're heading a little bit lower. For now, I could see a bit of consolidation, but volatility is still high, 14.3% on the 1 month. We were nearly 16% yesterday, so we've still got high vols. For example, euro dollar is now sub 6% volatility, 5.94. So the vol's still low in euro dollar. So if vol drops in dollar yen, that's probably going to lead to consolidation. Longer term, as I've been saying, this still has a 2022 vibe to it. So if you just take it in the context that we've seen that sort of move and we've seen a similar move here, can we head lower? Well, what's it going to take to go lower? It's going to take the US data falling off a cliff, probably, which it isn't at the moment. The market knows rate cuts are coming. Again, it's going to be the speed. If the Fed go a 50, if the Fed indicate another 50s to come and they're going to cut 100 or more by the year end, yeah, then I can see the dollar getting hit hard again, and we're probably heading much lower. But on the other side, if that's not the case, if the Fed are going to take it slow and steady, then I can see us finding a semblance of a bottom down here, a bit similar to this. I don't expect us to be doing another leg higher like that, though, unless the economy really takes off in the US. So maybe we get a bit of a bounce, maybe up back into the 150s, 152. I think if I saw 152 over the next few weeks, and depending on the reason, I'll like to have a little short against that. So I think longer term, we're probably setting up for a bit of range trading now. Remember, this is all coming off big hikes, big inflation. These are all big events within here, and especially what's going on in Japan. Everything is coming down. Rates are coming back down to what everyone or the banks hope will be normal levels. At that point, things will be slow and steady. That's not going to be good for volatility, but it just means we should set up some ranges, and we'll see a lot of consolidation in a lot of pairs if things turn nice and quiet over. And I'm talking the next 6 months to a year's time. So overall, Paul, yeah, we can go higher. We can also go a little bit lower, depending on the conditions. But from here, as a longer term trader, I'll be looking for some decent ranges set up and a bit of consolidation going on. So pick your poison, pick your levels, and potentially look to trade the ranges. I'm not going to look at gold because it's all over the bloody shop and I have no idea what's going on there. So I'm going to leave that one to you, Kane. Just looking at the clock. I'm going to bang it over to you, mate.
Yeah, okay, just a few I'm going to show, and I was going to show gold as well. And for once, which is not my usual approach, but for once I'm going to look at the shorter term because it is moving that much. And I think that we are back. So we had this big move, get me out of everything. We did see this move lower. It is also, if you look at how markets have reacted back in 2022, back in 2018, back on the global financial crisis, these kind of moves we have seen as well, even like bigger moves in percentage-wise in gold. The first move is to get out of everything. But if you look back at what happened then, the second wave is actually to go higher. Now, are we there yet? That's why I'm showing the short end. First of all, I don't know. And secondly, I would not assume that we are there just yet, because all the crap may not be out of the market unless this market really does 180s every 24, 48 hours, which we have seen in the bond market as well, by the way. But look at this little level here, and I would say like 21, 24, 15, 20, 21 in the short term. If we start to get back above there, I think there is a chance that we go back into the 24, 40s, 50s at least. But I would not rule out another attempt here, okay? We have done a few stops under the trend line. Yesterday, unfortunately, I missed it because as I said, I'm still a buyer on dips personally. But yeah, I think it may be significant that we held a higher low here. Okay, so and I still think that in the longer run, we are providing yields don't turn around massively, of course, and we start to get back above 420 on the US 10s, for instance. But In the longer term, this is still a consolidation which is pretty at higher levels. So, and I reckon that we are still, overall mood is still going to be after corrections to gradually creep higher again. This is how I feel the longer term gold. And the more crap there is elsewhere, I think we there's a chance we get into that after the get me out of there move back into this second or third wave or fourth wave now, and we actually go to higher levels. This is what I am actually looking for, is that in the end we are going to see higher levels above 2.5 really. Yeah, silver, a bit of a bounce. 26.5 is around here. Yeah, you have this prior low in silver. I would say though that there is a potential that we are going to test 26 flat. All right. Yes, we did have a bounce. We did have a bounce in the orders as well yesterday, if I'm not mistaken. On the ISM was overall green, right? If I'm pop. Let me just get back to it. Yeah, pop. Yeah, new orders popped up above 50 as well. Employment, business activity also above 50. The bounce here, but then we're coming back relatively easy. We're turning around 27 right now. I would love to see it get back above this traffic zone here to call the whole thing over, and that we start to get higher, go higher again. For as long as that doesn't happen, I'd say I'm not sure that we can get down to 25s, but 26.25 is still possibly, in my opinion, before the worst may be over. That is how I'm looking at silver. Yeah, Ali says Aussie, but yeah, the Aussie we're turning back around that level that I had before, that 64.80. We're turning around. I think this is your kind of hinge of on the door, or the middle point of your saloon door. We really crashed away, which actually came back onto a really nice support trend line here before it bounced around. But that's now well lower in the mid 63s. I don't think we get down there, but I think 64.60, 55.60. Keep an eye on that in the Aussie, and then if we manage to build a base here, we're probably going to creep back up to 65.30, 65.5. The market seems very undecided on what to do with the Aussie. It's sell the rallies, buy dips, I think, kind of scenario. So I can see a bit of a range creeping in here. And what I said is the same thing on the euro. So we had this spike higher, traded above 110, got rejected relatively quickly in this zone here, and we're back into the wedge now. I think fundamentally based, there is very little reason for the euro to outperform much apart from risk. So yes, we had the dollar move. Yes, we had the risk move underpinning the euro as well. But now we are gradually, slowly coming back off. This is a bit of a logic scenario. Take away this wedge, we are still inside the box, okay? And I reckon we are going to continue to trade inside the box unless something really dramatic happens to the dollar. And I would say that we are going to come slowly dribble back down to the middle of the sandbox and come back down here, unless, as I said, something happens to the US, or vols are spiking. Usually higher vols in euro dollar are sign that something may be wrong, but it's usually on the dollar side, okay? Lower vols means that euro dollar usually just drifts around, but slightly lower at times. Opposite to the yen, for instance, when we have really high vols in the yen, it's usually positive yen. When the vols go lower in dollar yen, it's usually positive dollar yen, okay? That is, compare it to the VIX. the VIX of the dollar yen side. All right. So and really, I think the S&P still 5,300 is going to be a massive level. Swiss is, despite lower data on continuously lower data on Swiss franc, it's still not putting in too much of a bounce. All those Swiss assets, we saw a bit of a bounce, but we are going to need calmer markets for the Swiss to turn around and start to weaken again. And with that, Ryan, I am going to call it a day, a week, and I'm going to spend some family time. I'm off to Belgium with the family, so I'm going to leave it all in your capable hands. And I see you all next week or towards the end of next week somewhere.
Thank you very much, mate. Have a great time off. Enjoy time with the family. Hope the weather's nice for you. Don't eat too many waffles. I know how good they are over there.
No guarantee on that one.
Yeah, have a good one. Thanks, everybody. I will see you all tomorrow. Have a great day. And yeah, take care, everybody. Have a good one.